Hey everyone, welcome back to Corporate Decoder, the place where we turn complicated business reports into something you can actually understand. Today we're diving into a report from Uniti Group, and trust me, it's juicier than it sounds. Think mergers, debt, and a little bit of financial maneuvering. It's like a corporate soap opera, but with spreadsheets. This report basically outlines Uniti's plan to offer some new notes, which is like borrowing a bunch of money and how they're going to use that money to pay off some old debts. It also gives us a sneak peek at what the company might look like after a big merger. It is all happening in the first half of next year. Community linked in the description below, where you can discuss this stuff with other nerds. This report is called an 8K, which companies file to announce significant events to investors. In this case, the big news involves issuing notes and a planned redemption, which is like a corporate version of refinancing your mortgage. The report is dated June 9, 2025, so this is pretty fresh information. Let's jump to the heart of the matter, the financial information. The report includes some pro forma numbers, which is just a fancy way of saying what if scenarios. These numbers show what Uniti's financials might look like after a merger with Windstream. Keep in mind these are estimates, not guarantees. Here's where it gets interesting. For the 3 months ended March 31, 2025, the estimated total revenue is around $977 million. That's a hefty chunk of change. But let's see what they did with it. Net income, which is the profit after all expenses are paid, is about 35 times $5 million. That is if the merger happened. Not bad, but we need to dig deeper to see how healthy the business is. This is a big one. Interest expense, it's nearly $190 million. That is a lot of money just to pay off loans. It shows that Uniti has a lot of debt. This can be a warning sign because if the company does badly, it can get into trouble with that debt. EBITDA or NTA before interest, taxes, depreciation, and amortization. It is used to see how well a company is doing without these things changing the picture. Their pro forma EBITDA is about $445 million. That sounds better. But remember, this is before paying interest on all that debt we just talked about. Now let's talk about investments, total capital expenditures, which means how much they spent on things that will hopefully make them money later. Negative $270 million. The parentheses around that number means it's negative a cash outflow. This may include investments in new equipment or infrastructure. Switching over to the balance sheet as of March 31, 2025, total assets are estimated at $11.3 billion. This is what the company owns, but here's the kicker. Total debt is $8.9 billion. That's a huge amount of debt. It is a big risk. Having a lot of debt makes them less able to invest in other things. So what's their situation after the merger? They estimate about $236 million in cash. Not bad, but not amazing given the amount of debt. And then after all the transactions are said and done, they will have closer to $295 million. The company has all kinds of notes or debts. Senior secured notes due in 2028 add up to $27 billion. They're trying to pay off $500 million of that soon. They also have lots of other debts coming due in 2027, 2029, and 2030. Windstream, the company they're merging with, also has a lot of debt. $222 billion in senior first lien notes. This brings their total debt to $844 billion after all the transactions, so the debt isn't really going anywhere. It's important to note that this number doesn't include the costs of getting rid of old debt, which can add up. Now let's talk about what's actually happening right now. Uniti is offering $600 million in new notes or bonds. Basically, they're borrowing $600 million. They plan to use this money to pay off $500 million of their existing debt, specifically those 10.5% secured notes due in 28. It's like taking out a new credit card to pay off an old one, hoping for a better interest rate. These notes aren't being offered to the general public. They're only available to big institutional investors. Like any good corporate report, there's a section on forward-looking statements. This is where the company says, hey, these are our plans, but things might change. They mention a whole bunch of risks. The merger might not happen. They might not get the benefits they expect. Inflation could hurt their business. Their customers might not be able to pay their bills. They might lose their REIT status, which is a special tax status for real estate companies. Also, there could be equipment failures, cyber attacks, natural disasters. It's basically a list of everything that could possibly go wrong. They also mention that these risks and many others have already been covered in previous reports filed with the SEC. So what does all this mean? Uniti Group is making some big moves. They're trying to simplify their debt structure and prepare for a major merger, but they're also carrying a lot of debt and there are plenty of risks involved. The merger with Windstream is a big gamble. If it pays off, it could create a stronger, more profitable company. But if it doesn't, it could create even bigger problems. The biggest weakness is the amount of debt. It's like walking a tightrope with a bowling ball, and it makes the company vulnerable to interest rates. One notable risk is that the merger will not happen at all, and they have already planned everything around it. However, they are not hiding anything. They even list all the risks of their company as well as Windstream's. Overall, they are transparent and give investors as much information as possible. Alright, that's our breakdown of Uniti Group's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.